I'm Larry Wilkinson, and I head up our Reinsurance, Advanced Analytics, ILS, and Asset Management teams at S&P. So far in the conference, we've had some excellent perspectives from our CEO and CFO panelists. In our next panel, we'll try to tackle the key question for the industry, taking stock of where we are today and what the path forward looks like. More specifically, we'll look at the extent to which recent cat events will serve as catalysts for change within the industry. Joining me on stage today are our three distinguished Wall Street panelists. To my left is Jay Cohen, who's a managing director and equity research analyst at Merrill Lynch. To his left is Jay Gelb, who's a managing director and equity research analyst at Barclays Capital. And finally, on my left, representing the fixed income perspective, is Rob Hauff, who's a managing director and research analyst at Wells Fargo. Thank you for joining us today. So before we begin the panel, I'd like to first ask our moderator to throw up our first polling question. So I'll revisit this at the end of the panel, but the question is, what do you think will have the most impact on the insurance sector during the next 12 months? Is it pricing, M&A, capital management, or disruption? So I'd ask the audience to do is go ahead and use your app to go ahead and weigh in on your answer, and we'll revisit the answer to that question at the end of the panel. And also, before we begin, I'd like to remind the audience that you have the ability to submit questions to the panelists via the app, and I'll try to kind of weave those into the conversations as we go along. So I guess my first question I'll throw out to Jay Cohen is, you know, we're a good way through the third quarter earnings season at this point, and what are the most pressing issues that you see investors facing, or what are the things that come up most in conversation?
Yeah, maybe I'll save some for Jay to talk about as well, but the two things that I'm talking most about with investors are pricing, shocking, and the answer to that question, by the way, is pricing. So if you picked a different one, you're wrong. It is really a critical issue, and there's a lot of uncertainty. As you've heard throughout this morning, that really affects how people think about insurance stocks and the valuations, because we're driven by expected ROEs, and price is a big part of that. So price is definitely a big issue. The other one recently that we're getting asked a lot of questions about are taxes, specifically for the Bermuda-based insurance and reinsurance companies. You know, for years we've heard about the potential for this ability to reinsure to offshore affiliates maybe going away, and it scared the hell out of people. And now that it's potentially here, you know, the stock sold off on some of that news. But if you start to do the math behind it, you realize it may not be such a big deal financially, but that's getting a lot of questions.
Mm-hmm. Okay. Jay?
You know, I'd say going through the third quarter earnings season, it was kind of the reckoning of companies having to actually finalize what their loss exposure was for the third quarter hurricane losses. Then of course, so in addition to $100 billion potentially of industry insured losses from hurricanes in the third quarter, you had raging California wildfires in the fourth quarter, which we think could be up to $10 billion, 2 earthquakes in Mexico. And if we think about overall catastrophe losses for the full year 2017, I mean, you're potentially building up to $135 billion, which interestingly would be the third time that's happened on record. As we would have expected, the reinsurers took a bigger brunt of the percentage of losses from the catastrophes than the primary companies. It feels like a lot of the losses were borne on the Bermuda reinsurers, more so than the European companies. And as Jay said, it was really all about, well, what does this all mean in terms of the outlook for pricing? And I'm sure we'll get more into that.
Okay, so that's kind of the equity perspective. I guess I throw it to Rob. Any differences with the fixed income community?
Yeah, I mean, I guess I break it down into two components. One, which was the reaction of our market, the fixed income markets, which we haven't seen, you know, a mega hurricane since 2005. So we'll talk about that. And then the second piece is obviously the fundamentals and how these companies look on the other side of these events. And, you know, bond spreads really started to move out aggressively as Harvey was headed towards Texas. And they really peaked out the Friday before Irma made landfall. And that Friday, I'll never forget a phone call from my trader who said, bond spreads were probably 50 wider for some of the more exposed names, and he basically said, I can buy bonds at my price, which is usually a red flag to buy everything in the market. But come the weekend, Irma took a less disastrous track, and it was like Mike McGavick said earlier, the tone changed at Monte Carlo when Irma shifted. We came in Monday, and bonds started rallying. Now, this was a significant difference from 2005, where we didn't see the bond market react until really the end of hurricane season, and we saw a big rally. So we moved much, much quicker, which was a signal that bond investors were a little bit more comfortable with the losses. Now, you shift to the fundamental picture, right? We model out 25 different P&C reinsurance companies. And as the losses came through, we just finished this exercise last week. We said, what was the average decline in shareholders' equity from Q2 to Q3? It's basically 1%. We back out AOCI. What happened to debt leverage? Debt leverage, debt to cap for most of these companies, it went down by about 50 basis points, believe it or not. Some companies paid down debt in the quarter. So capital and liquidity positions were actually in pretty good shape. Parent liquidity was in very solid shape. So then you ask, okay, how did the rating agencies react? Well, you heard this morning, I think, from S&P, they had 2 outlook changes. There was really no disaster from the ratings. So it made us say, well, where is the capital depletion from these events? And so we actually grew kind of cynical on the ability for the sector to raise pricing on the heels of this. I think there will be some price increases, but we're pretty cautious in the approach here, especially since it looks like the companies are going to come through this in much better shape. And I think some of that's attributable to third-party capital, which we're going to talk about, I think, a little bit later. But overall, I'd say bond investors came through this with a high degree of comfort. And I've told most of my investors, the violence that you saw in the bond market this year, you probably won't see next year if we have another round of catastrophes, because I think everybody's dusted off their handbook for how to react to these events. So you may get a more muted reaction next year.
Thanks. And I guess going on to the topic, you just mentioned alternative capital. I think kind of coming into this season, I think a lot of folks waited with bated breath to kind of see the reaction of alternative capital investors to see if kind of given the first strong loss season that's kind of been here in the last half a decade, whether you'd see some kind of retraction from the industry, or if you'd still see ample supply of capital coming to the market. Any first or initial reactions to that?
In full disclosure, I'm not an expert on the alternative capital market, but just anecdotally, what I've seen, the Markel CatCo funds have re-upped. I think Credit Suisse re-upped its fund and increased the size. If you look at I think XL renewed its cat bonds recently, and it looked like at the extreme tail of that tranche, pricing could have arguably gone down. I think exposures were expanded to include Puerto Rico and the Virgin Islands. So on a risk-adjusted basis, maybe you didn't see that much of a move there. So it's probably too early to tell. I think has been sort of the theme of this conference. But I think the biggest question is, will the supply outstrip the demand? And will it come later this year or at some point next year? And how does that impact pricing? And again, we have a slightly more cautious approach, and I don't know what the duration of these price increases is going to be if we see them.
You do get a sense from companies that manage public companies that manage third-party capital. They're all kind of optimistic about their ability to raise more capital. No one's saying we're going to have a big challenge getting more capital in the door at this point. And so that optimism tells me we'll probably see a decent amount of capital come back in, and it might mute the kind of increase or the duration of the increase that you would see.
Alternative capital is really important in a number of ways. I mean, it's already 20% of the global property catastrophe reinsurance market. That's double from what it was in probably 2010. It's also a very major contributor to the retrocessional reinsurance market, which is retrocessional drives into reinsurance, drives into primary commercial. But we see no supply-demand imbalances there. So we're talking about earlier in the day, there was talk of retrocessional reinsurance pricing going up 20 to 30%, and a month ago that was going to be up as much as 50%. So there already seems to be some speed coming off that pitch. In addition to that, it just feels like if there's plenty of existing capital that's ready to reload on the funds and new capital potentially on the sidelines, It's like, so retro pricing will go up, reinsurance pricing will probably go up less, and primary commercial even less so. But it doesn't feel like it did in 2001 or 2005, where there were big supply-demand imbalances that spiked rates. I just don't see it this time.
Okay, thanks. The next thing I want to go back to is revisit a couple of comments from the earlier panels. I think at the beginning of the session, I think Ben Bubeck had mentioned kind of the need to respond to the public in a timely manner and kind of get disclosure out there as quickly as possible to assess the situation. I think the tension there was kind of captured in the CEO panel, where there's a little bit of a reluctance to kind of give up too much data and give up maybe some competitive advantage. And I think the thing we're struck by at S&P is, given a lot of the advancements in ERM, modeling, understanding of basic risk, I guess what I'm wondering is, over the last 5 to 10 years, have you seen a changed speed at which people are able to kind of get out to the market with their views of losses? And where do we go from here? Is there a better state of kind of reaction we can get to?
I think it depends on the loss. I mean, if you look at Harvey, to have a $30 billion largely flood loss, I mean, that's not something that I think the independent catastrophe modeling firms were picking up as much. Irma, more of a traditional wind loss. But if that veered a little further east and went up the Atlantic coast in Florida, you were talking about a $100 billion event, which is 4 times of what it was. And then, of course, Maria, I mean, the amount of devastation there, and the ability to have at least a $35 billion insured loss in Puerto Rico, I think was unprecedented in terms of what people even thought about. So I think the CEO panel captured it really well in terms of, as equity analysts, as market participants, I'm much more concerned that companies, when they provide a range, that it's accurate. And if we need to wait a week or two in order to get that, that's fine. I don't think there's any real benefits to going first. I think you can only have downside in the eyes of your investors if you have to raise your loss estimate further down the road. So it's important to get it right.
I mean, the risk in going too early is you get it wrong. The risk in waiting is the market's going to make an assumption for you. Right? We always have to build something in for it. And so we're going to be guessing for maybe an extended period of time. And that could change your stock price in the short term. But if I'm a management team and I'm thinking long term, not the next quarter, I'm going to say I have to get it right first. And that's really what they should be doing. And I think most of them really try to do that. But there is a period of time where the market's going to make its own assumption. The stock market will make its own assumption. And your stock will trade maybe incorrectly based on those assumptions.
That's a fair point. I mean, we're still waiting to hear from some major companies, right? Munich Re has sort of sized their loss. Berkshire Hathaway, it was a one line in the 10Q, right? $3 billion. State Farm, maybe we'll find out someday. Maybe not. It's good to be a mutual. But it's we're looking at the ticks in the daily stock price and having investors call us up and trying to figure it out. And as an external observer, it's pretty hard to do. You can start by using market share of premiums, but premiums have very little to do with losses. Right? Limits are related to losses, not premiums. And then, of course, when you're looking at market share, it's only on a gross basis. It's not net. So you need to take all that into account, too. So it causes a lot of late nights in the analyst community. Yeah,
and I think on our side within S&P, I think we want to get a general sense of the magnitude of things. And I think you've got this tension within a lot of the companies where they're want to be very precise and don't want to have to go back and revise things either upward or downward. So that's that kind of tension that you see in terms of the timeliness of coming out to provide some perspective. In terms of the recent quarter, are there any surprises or any interesting things that you saw in the third quarter results?
From my standpoint, there wasn't that much surprising about the numbers. Most companies have come out with an estimate beforehand. So then if we know what the cats are, if they're in line, then the next bit of information we're going to look at is what's the underlying loss ratio, excluding cats, excluding prior year reserve changes. And there weren't a lot of surprises. I will say the one thing that surprised me a bit is kind of how the stocks reacted. When numbers were in line, companies might have talked about achieving price increases. In some cases, the stocks didn't go up. And I think one of the components of that was the capital position. if investors feel as if a company is maybe not impaired, but may not have enough flexibility to fully take advantage of a changing market, the stock will not do as well. Even though it might be cheap, even though its margins might get better, not being sort of in the front of the line with a lot of capital and fully taking advantage of that change made some stocks go down, actually. That was one surprise, but the earnings themselves, not a lot of surprises.
A couple things that I'd point to are first some of the significant differences between gross and net losses for some of the insurers and reinsurers. So clearly they were astute buyers of lower priced reinsurance. I mean, for some of these companies, if the gross equaled the net, it would have been much more of a tough conversation from a capital adequacy perspective. But they're smart buyers of reinsurance. Aside from that, even kind of beyond the reinsurance earnings season, I was pleasantly surprised with the continued strength in margins in personal auto in the U.S. That seems to be a very favorable market. Also, is kind of we were thinking going into earnings, the brokers weren't exactly talking up the benefit of potential rate increases on their own results. So that kind of remains to be seen. And then in terms of company-specific issues, AIG having another reserve charge after the year-end impact, that was taken as a somewhat negative surprise, and kind of shows it's going to be a long road for AIG's recovery. Hartford buying a group disability business as opposed to announcing a sale of Talcott. That's something I don't think a lot of people were expecting. And then Berkshire, which is largely exited property cat reinsurance, having a $3 billion loss among its auto, it's Berkshire Hathaway Re, Gen Re, and the primary business. I thought that was pretty sizable.
Yeah, I mean, breaking it down between surprising and interesting, I echo a lot of what J&J said here, but I mean, I thought AIG's charge was probably more interesting than surprising, and it begs the question of whether or not they're still playing catch-up or if they're trying to get ahead of loss trends and where they could be going. So are others going to be taking charges down the road in the more recent accident years? On the surprising side, it was less about the numbers for me and more about listening to the management commentary on where the market could go from here. And historically, we're debt investors, we're a pretty cynical bunch, but historically when all the management teams are saying the same thing, you go, oh, they're all lying, right? But there was an element of that in this quarter, but there was also some dispersion as well, and some taking another tack. And just to play devil's advocate on my own thesis, that could be indicative of pricing actually moving up more aggressively than we think. So those would be my comments.
Okay. So just changing gears and kind of looking out to the future, I guess, and I'll take your caution, Jay, but pricing is definitely something I have to bring up over the course of the panel. And I guess maybe I'll start out with Jay Gelb. Is just when you look out to the January renewals, what are you expecting both kind of in the North American sector and maybe the implications for the rest of the world as well?
Sure. Well, first I'll kind of paraphrase Yogi Berra. It's tough to make predictions, especially about the future. So when we think about everything we've heard today from the CEOs and CFOs who are actually seeing the business be transacted, and what we're hearing from the brokers and what we're hearing from other industry participants, I don't think rates are going to be up as much as a lot of people are talking about. For loss-affected business, I mean, there will be certain exceptions, of course, but I'm thinking more in the 5 to 15% range on property cat pricing as of January 1st, although you won't see the full effect of that clearly until mid-year with the January and Southeast U.S. renewals, and there's probably carryover there into 2018. Retrocessional pricing will be up the most, probably at least double digits, more like 20%, perhaps 25%. Policy terms and conditions will tighten, and as was said in the prior panel, that's just as important a benefit on the bottom line as improved pricing will be. I think the reinsurers will really try and hold the line on getting price improvement, but there's still plenty of capacity. We don't see any supply-demand imbalance, and the primary companies will certainly push back. I mean, they're just not going to sit there and take take price increases. So it's a function of how much do the reinsurers feel they can push for to get rate improvement, but not so much that they risk losing their long-term account. So I think that's something to keep in mind. And of course, the reinsurance brokers will work hard on behalf of their customers. And keeping in mind that hurricane losses are generally braced for by the industry. They shouldn't be surprised. 3 major hurricanes within 6 weeks. Yeah, that was a surprise. But the magnitude of losses. I mean, we were saying in the spring that if there was $100 billion of insured losses, it would basically stabilize pricing, and we're pretty much sticking by that.
Okay. And I guess one thing I'd ask is there anything different about this time around? As we saw, like in 2005 and 2011, strong recoveries after a strong cat season. And I'm wondering if anything that you've seen maybe might dampen those expectations going forward or this time around.
I'm not sure. I guess what's different maybe is other parts of the business are even more competitive. So we're starting from maybe a lower spot in certain lines of business. So if they can use these cats to raise prices, there's certainly room to go up. But at the end of the day, the pricing in any line of business will be determined, I guess, partly by supply and demand, and certainly for a very line like cat, where supply is a big issue, that'll be an issue. But the other issue is expected returns. When companies are writing business, they're looking at their expected returns. Have your expected returns changed because of these catastrophe losses? Have you learned something that says, gee, we think we're not pricing this business accurately? In the cat business, maybe. As Jay pointed out, the flood aspect of Harvey was not modeled well. But in general, storm hitting Florida is not that surprising. You don't learn a lot by that. Outside of cat, have your expected returns changed in workers' comp, in D&O, in commercial auto? The answer is no. Would tell you pricing probably won't change that much. You listen to the companies, and as an analyst, having covered this group for a long time, these guys try to talk the market up a little bit. And I would too, if I were them. But you have to divorce that from economics. They also want to hang on to renewals. And so I'm a little skeptical. I think there will be an increase in cat. 5 to 10, maybe even 15% in loss-affected lines is not unreasonable. Outside of cat, I'm not looking for a big change at all. Maybe some more stability, but that's about it.
In terms of dampening expectations, the other points I'd look at were, if I look down the list of companies we cover or track, it's not like any company's lost 20% of their common equity. Right? The rating agencies are not putting a lot of pressure on these companies to perhaps go out and have to raise common equity. And that's what we saw last time. And by last time I mean post 9/11, post Katrina, Rita, Wilma. If you look at Hurricane Superstorm Sandy in 2012, I mean, it was barely a Cat 1 that impacted the Northeast, and it caused $30 billion of losses. I don't think a lot of people were expecting that. Well, prices improved for a year, then they went down for 4 years in a row. And unfortunately, I think that's the position we're going to be in. If there's no major catastrophe loss within the next year, I think we'll get this lift up in pricing in 2018, and that's it. Where rates will start coming back down.
Okay. Let me make one more point. I'm sorry. What you don't hear at all in the market is fear. I haven't had one company say, gee, we didn't realize we had this exposure. We really need to pull back. We really need to rethink what we do. None of that. Everyone is excited about the potential for price increases. That means you're probably not going to get them all that much. So last point. I don't know, Rob, if you wanted to say.
Yeah, I think what traditional capital providers such as ourselves are struggling with is post-event, whether it's 9/11, the 2005 storms, we see companies come to our market to raise capital. And as Jay said, we're not seeing that right now. The thing that's a little different this time from '05 is all the capital raising is going on away from us. So it's going on in these third-party markets, and we don't have a good lens into that. So we're really relying on the management teams to give us color around that, and there's still a lot of seek and discovery there as well. If I can make one comment on how the companies have used that capital, though, it seems like if you look at the hits to balance sheets through these events compared to 2005, they're much less severe. So if anything, it's been a very effective risk management tool to actually protect the traditional capital providers for these companies.
Yeah, I think in 2005, losing 20% of your book value was not uncommon.
No.
Some lost all their book value.
Yeah.
Yeah. So I guess pivoting on that is when I look out to the kind of prognosis for the next 2 to 3 years in terms of capital management, in terms of share buybacks, capital raises, what's the prognosis for that?
I mean, I think in the near term, there'll be a little bit less. One, because you lost some money. Secondly, because you'd rather potentially use that money to write business, as you should. Assuming that we don't get a massive turn here, a massive change in the market, my sense is the industry goes back to where it has been, and that's taking, on average, 85% of the earnings and giving it back to shareholders in buybacks and dividends. We just had one special dividend announced yesterday, American Financial Group. And so I think there is a mindset that we want to use the capital first, but if we can't, for most cases, let's give it back to shareholders.
I'm a little less optimistic maybe on the capital return story. I think it might be less than three quarters of annual earnings. Dividends, sacrosanct, right? Companies want to continue to pay those and raise them modestly on an annual basis. I think even before the storms, we saw kind of a cresting in terms of the pace of share buybacks among some of the major companies. I think that'll continue. I mean, like Jay mentioned, if you have a better opportunity to invest capital in the business, that should be their first choice as opposed to automatically returning it to shareholders. And quite frankly, valuations are already at 5 and sometimes 10-year highs. So I prefer companies to buy at low valuations as opposed to driven up ones. Aside from that, it's I think after what will probably be the worst catastrophe year on record, it's probably worth taking a pause maybe on the buybacks.
Okay.
Yeah, I mean, I think the CFOs on the panel before us expressed it very well, which is I didn't hear a big shift in strategy. If the market's there and pricing is there, they'd rather deploy their capital into growing their books of business, which as a debt holder, I love to see. Grow your earnings base, grow your capital position, that's great. If the pricing is not there, I'd rather see them return that money to shareholders instead of make bad decisions on the underwriting side. So it's very possible a year from now things look very similar to what they do today, or we could see some nice growth in balance sheets and earnings from better pricing. So.
And we touched on valuations, and that obviously ties into the next area is M&A. What do you see as the M&A environment that's going to exist over the next 12 to 18 months?
There's a lot of buyers. Most companies seem to want to make acquisitions. They're looking for deals. They've got enough capital, a little less than they used to. What we don't have are a lot of sellers. Not a lot of management's willing to give up their seat. And there's not enough pressure on them for the boards to say, you really need to think about your own independence. And so I think we will see ongoing consolidation, there's no question. Size and scale are increasingly important. But I think to see a bigger wave, you would need to see more pressure. You would need to see reserve additions. You would need to see maybe changes in the investment portfolio, which took away a lot of capital. All of a sudden, these companies feel a little bit impaired, and they'll look for a potential buyer. But without some additional pressure, I think it's kind of steady as she goes. Ongoing consolidation, but not a major acceleration of that pace.
We saw a very heavy pace of consolidation prior to the storms for the prior 2 years. And it's, for the last companies to have been taken out in Bermuda at least 1.5 times tangible book, 15 to 20 times forward earnings, I think those are pretty full valuations. So, when the bankers from Barclays and Bank of America, Merrill Lynch, and Wells Fargo are going around the island or elsewhere, the companies that are potential sellers are going to want to look at, well, what was the last valuations on those deals? I don't know if we'll get there again anytime soon. Plus, you have to look at relative to the last stock price or takeout premium relative to an unadjusted price of prior deals. I mean, a lot of these stocks are already at all-time highs. Book values have gotten clipped as a result of the storms. I think M&A is going to take a pause here, especially as people need to fully quantify the impact of the storms on their earnings and balance sheet, on the return profiles, which I don't think will go up that much. And the buyers are going to be taking a real hard look at the underlying results. Attritional loss ratios, those have been going up. Reserve adequacy becomes a little more suspect. But one thing I think that we will see that might be a surprise to some people on the capital management front is I think in the not too distant future, Berkshire Hathaway will start paying a shareholder dividend or, again, raise the threshold on its share buybacks. Warren Buffett has said he's already got $110 billion in cash and short-term investments on the balance sheet. He said he can't come back 5 years from now and have that be $150 billion without doing a large deal. So I think within the next year or so, even before Warren Buffett is done being CEO, you'll start seeing Berkshire pay a dividend or buy back more stock.
Thanks. I think Deborah?
Yeah, I think the storms have potentially delayed M&A activity. I think absent these storms, we would have probably seen more deals start getting rumored or come to fruition as early as next year. But yeah, if I'm a management team and I have internal growth opportunities, I'm going to be internally focused. I don't know how long that lasts, though. We'll find out 1/1 what pricing looks like, and maybe by mid-year next year, if it doesn't look like pricing has a lot of traction, M&A deals have a pretty long lead time. I think you're going to get stuff rumored as early as the spring, to be honest with you.
The next topic is on disruption in insurtech. Obviously, this topic comes up in kind of a lot of different panels and a lot of different formats. Do you see that having any inroads in the industry in the next, say, 2 to 3 years?
There's a lot of ideas out there. Initially, 5 years ago, this topic was more around the opportunity for expense savings. I mean, if you look at the industries, the overall U.S. industries expense ratio, it's around 30%. 30 years ago, it was around 30%. So we're not seeing a tremendous amount of improvement in the expense ratios over time. So that would be a big opportunity. It feels like property casualty insurance in a lot of ways is almost like the last part of the financial services industry that is yet to be meaningfully adopting technology to improve its distribution or its underwriting or its administrative costs. So there's a lot of opportunity there. Within the past year or so, we're certainly seeing a lot more on the revenue side. If you look at what's happened in personal auto, I mean, so much of that business has shifted towards direct distribution, in part because the technology has gotten so good. It feels like in small commercial, companies are starting to get there, perhaps even going direct in some cases. We've seen some examples of companies you can do 2 or 3 clicks and pull the rest from open source information, and they can get all the underwriting, and you don't even need a person involved to get the quote to bind. We need a little more action there on the large and middle market in primary commercial. Reinsurance, there seems to be an opportunity there too. So it feels like kind of open fields.
I don't have a strong view on this, to be honest with you. Fixed income investors don't ask too many questions on insurtech, but I'm all for technology advancements. So I think anything they can do to manage expenses and improve modeling or risk management is a net positive.
There's so many cool things that we talk about. We had a session, I guess it was 2 years ago, on new business models. These startups come, they all had a different business model. It was really cool. At the end of the day, investors just didn't care that much. This industry moves very slowly. So whatever we see will likely be on the margin. You could think out maybe 10 years and things will be a bit different. The next 2 or 3, I just don't think you'll see that big a change. And remember, too, the returns in this business are not terribly high. It doesn't attract a lot of outside new money. The distribution side is a little different, and I think you will see more investments there. I mean, the one risk you have for the companies is if distribution becomes very efficient and very transparent, anytime you shine a really bright light on the price tends to go down. And so you could see a further commoditization of probably much more on the auto insurance side, honestly. But I'm not, from the stock standpoint, we're not building it into our recommendations at this point.
It's a slow burn in terms of getting it done. But you look at a company like Progressive in auto, I mean, they've been able to, people thought initially they would be meaningfully impacted by channel conflict, by writing in both personal and the direct channel. They've handled that pretty masterfully. The ability to, I mean, they even had I remember the competitive price ticker right on the website. I mean, that kind of price discovery is something that people would have thought of even when they weren't the lowest price. You look at what's happened with that company's top line margins, valuation multiple. It's probably one of the best out there from a technology standpoint. Geico is another standout on the technology front. I mean, clearly, companies like Berkshire Hathaway, AIG, private companies like Hamilton, in terms of the use of data science with Two Sigma. It seems like there's some pretty exciting untapped opportunities there, but it's going to take a long time to play out.
Okay. So before we transition to questions from the audience, I'd like to go back and revisit our polling question we had at the beginning of the session. If I gave you pull up those results. Okay, so you get the answers? Okay, so it looks like the first answer, pricing, was kind of the most dramatic one, followed to a lesser extent by, this was a capital management, and then disruption, and finally the M&A side of things. Do you agree with those results?
Yeah, I would have put pricing even higher, but yeah, no, absolutely, that makes some sense. I mean, the fact is, M&A will play out. From my standpoint, let's say I said, I think M&A is really going to heat up. Then my clients will say, what do I do about it? Buy some stocks that'll get taken out. Okay, which ones are those? Like, I don't know. So there's not much I really can do with that anyway. Over time, it's good. As I said, from a disruption standpoint, it plays out over a much longer period. What can they control now? It's really the underwriting, and pricing is obviously the key lever.
From a stock standpoint, I think sometimes it's really important to remember that just because property cat reinsurance pricing goes up double digits after big catastrophe loss, that doesn't affect any of the perhaps non-cat book, the big back book, right? I mean, that doesn't necessarily get affected by prop cat. You're talking about 20-25% of the subject business. You do have to think about, well, what's happening with the attritional loss ratios? Probably not getting a lot better. Expense ratio, probably not getting a lot better. And then, of course, the industry's been drafting off reserve releases for over a decade. At some point, that's going to come to an end. We're in the longest stretch of reserve releases probably on record. And it didn't end well in the late 90s. I'm not saying that's going to happen again, but if general economic inflation picked up meaningfully or loss cost of inflation took off, companies aren't priced for that as it stands now. And when we look at how much of primary commercial reinsurers' earnings are driven by reserve releases, if you took that out, your earnings might be cut in half in some cases.
Yeah, I would agree. Pricing is hands down the most important element. I think we're at a very interesting inflection point coming into next year where reserve margins have grown very thin. I mean, our strategists are calling for interest rates to potentially start moving up in the middle of next year. So you get this dynamic where inflation could start to rise, interest rates could start to rise, putting a little bit of pressure on balance sheets. And then if you have another round of mega cats next year or reserves that prove to be deficient, you have nothing to offset it. So I think the industry could be a little lucky in getting the timing of price increases right now, but to me it feels pretty necessary. Whether or not we get it is certainly up for debate.
I mean, reinsurance pricing has been cut by 40% since 2012. A 10 to 15% or more increase is just slightly getting back to where we were. I think if I looked at a recent broker chart of rate on line for global property cat, I think we're back to pre-9/11 levels, not adjusted for anything. Right? That's not exactly a
Home run.
so much of a compelling story.
Yeah. So with that, I'll turn it over to audience questions. I have a couple of moderators running around with mics. Any questions from the audience? Well, we're trying to collect up questions. I think we had one on the app. The question was around enterprise risk management. Basically, the question was asking, companies made a lot of investment in this area over the course of the last 10 years in terms of strengthening the practices they observe internally and how they manage risk. What have we seen as kind of the key benefits of that over the last several years?
It's tough to tell. I mean, well, the report card of that comes when you see, if there's a large catastrophe event, how much book value they lose, right? Now, keeping in mind, of course, that in a large-scale severity event, the reinsurers are going to take more of a brunt of that than the primary companies. But that, to us, that's the report card. How much did you lose? Much more than a year's worth of earnings? Did you lose, more than 15% of book value in any given event? But if you think about it in terms of post financial crisis, in terms of how much better they are probably on investment risk, reserving risk has probably hopefully gotten better. We'll see. Then cat risk.
Yeah, you can't tell. You sit down with a management team and you ask something like, well, how's your risk management? It's really good. And by the way, the report card is when something bad happens, and you have to frankly look at it over many years, right? One event, someone does really well, it could be luck, good or bad. And so you have to really look over many, many years to see how a company does relative to catastrophes, relative to financial disruptions. But I will say that it looks like the industry, from a cat standpoint, does a pretty good job. After Katrina, I'd have friends of mine who are not in this business ask me, how many guys went bankrupt? You must have lost a lot of companies. Like, no, very few. And most companies spread the risk really well, and they think very intently about these issues. So I think it's one thing the industry does really quite well.
Yeah, I agree. I mean, history is your best indicator. This is actually where I think the bond market does a really good job of differentiating companies because bond investors tend to take a very long-term view, especially those of us involved in 30-year risk. And you can certainly see the companies with the best risk management practices and who have come through the storm seasons the best over the past 15 years. They trade the best in the market. So it's history is your best guide.
Okay. I think one of the other questions we had from the app was, what would you favor between accuracy or speed when it comes to reporting losses?
Accuracy, definitely.
Totally agree. There's no prize for being first. There's a prize for being most accurate.
Yeah, I would agree. We just collect coupon payments, so accuracy is great.
So with that, I'll end things on a happy note. I'd like to take the time to spend some time thanking our analysts for joining us for the panel today.